Welcome to today's video on avoiding the 10% early distribution penalty when you accidentally withdraw from your Roth IRA or traditional IRA. We'll show you how the IRS 60-day indirect rollover rule can rescue you, and more importantly, how to make sure your rollover is coded correctly so you don't get hit with taxes and penalties. Let's dive in and then move into the agenda to see what's coming up. Here's our roadmap. First, we'll define the problem. Next, we'll unpack the 60-day rule. Then, we'll walk step by step through how to fix the mistake. After that, we'll compare direct transfers and indirect rollovers. We'll then address differences between Roth and traditional IRAs. We will reinforce concepts with diagrams and timelines, test your understanding with a quick quiz, and finish with key takeaways. Before we get started, we'll add a quick but important disclaimer. This video is for educational purposes only. It is not tax, legal, or investment advice. Individual circumstances vary and tax rules change, so always consult a qualified tax professional or financial advisor before taking action. With that important context set, let's transition to the common mistake that triggers the penalty. A common operational error is withdrawing money from your Roth IRA or traditional IRA when you intended to contribute. If you are under age 59 and a half, the IRS may consider this an early distribution, potentially subject to a 10% penalty and possibly income taxes. However, there is a window to fix it if you act fast. Let's move to the 60-day solution. The IRS 60-day indirect rollover allows you to redeposit the full amount of a mistaken IRA withdrawal into a qualified account within 60 calendar days and treat it as a non-taxable rollover. Because the funds were paid to you, this is indirect. The most critical point is that the receiving custodian must code the incoming funds as a rollover contribution rather than a regular contribution. The 60 days include weekends and holidays. If any taxes were withheld from the distribution, you must replace those withheld amounts out of pocket so that the full gross distribution is rolled over, otherwise the shortfall is taxable and may be penalized. The one rollover per 12-month rule applies to IRA indirect rollovers across all your IRAs. However, it does not apply to direct trustee-to-trustee transfers. Now, let's walk through exactly how to fix the mistake step by step. Here is the action plan. First, verify the date you received the distribution. Your 60-day window starts the day after receipt. Second, call the receiving custodian and request the form or workflow to make a rollover contribution, specifically categorized as a 60-day indirect rollover. Do not use a regular contribution form. Third, redeposit the full gross amount. If any withholding occurred, replace the withheld portion from your own funds so the total incoming amount equals the gross distribution. Fourth, place the funds into the correct account type, traditional to traditional or Roth to Roth, unless you intend to perform a taxable conversion. Fifth, complete all required paperwork and confirm how it will appear on your statement and on IRS Form 5498 as a rollover contribution. Sixth, document all details, including dates, amounts, and tracking information. Seventh, after the deposit posts, confirm the custodian's coding shows rollover contribution. Eighth, manage your timeline so you finish well before day 60. Ninth, if the window has closed, ask the custodian about self-certification under Revenue Procedure 2016-47 or consult a qualified tax professional. Next, let's visualize this process with a flowchart. This flowchart begins at the accidental IRA withdrawal, then checks whether you are within 60 days. If you are, it shows the sequence. Contact the receiving custodian, obtain the proper rollover contribution form, and redeposit the full gross amount. If withholding occurred, you add cash to replace the withheld taxes before depositing. Then deposit into the correct account type, submit paperwork, and verify that the custodian codes the incoming funds as a rollover contribution. This results in avoiding taxes and penalties. If you are past 60 days, the flowchart points you to consider self-certification under Revenue Procedure 2016-47 or to consult a tax professional, since outcomes can vary based on facts and relief eligibility. Now let's compare indirect rollovers with direct transfers. On the left is an indirect rollover, where the funds are paid to you, and you must redeposit within 60 days. It counts toward the one rollover per 12-month limit, can involve withholding that you must replace, and carries a higher risk of miscoding without proper paperwork. On the right is a direct trustee-to-trustee transfer, where funds move between custodians. There is no 60-day clock. It does not count toward the 1 per 12-month limit and withholding does not occur. In general, direct transfers reduce operational risk compared to indirect rollovers. Next, let's consolidate the critical limits and gotchas in a quick table. This table summarizes key operational rules. The 60-day window counts calendar days starting the day after you receive funds and includes weekends and holidays. The 1 per 12-month rule applies to IRA indirect rollovers across all your IRAs. Withholding on IRA distributions is generally elective, whereas qualified plans may impose 20% withholding on distributions. In any case, you must replace withheld amounts to roll over the full gross. Coding is crucial. The receiving custodian must record the deposit as a rollover contribution, or the IRS will treat it as a taxable distribution. Required minimum distributions cannot be rolled over. Finally, for Roth IRAs, withdrawals of contributions versus earnings are treated differently. An incorrect classification can trigger taxes and penalties. Next, we will address Roth versus traditional nuances directly. For Roth IRAs, qualified distributions are tax-free, but an accidental withdrawal can include earnings that are taxable and potentially penalized if not corrected. For traditional IRAs, distributions are typically taxable, and the 60-day rollover, if properly executed and coded, prevents both income taxes and the 10% early distribution penalty. To avoid unintended taxable events, generally roll Roth to Roth and traditional to traditional. Administratively, you will receive a Form 1099-R reporting the distribution, and the receiving custodian will issue a Form 5498 indicating a rollover contribution. If you are at least 59.5, the early withdrawal penalty may not apply, but tax consequences may still arise without proper coding. Required minimum distributions cannot be rolled over. If the 60-day period has passed, inquire about self-certification relief or consult a professional. Now, let's test your understanding with a quick quiz. Quiz time. The question is, which action most reliably ensures your redeposit is treated as a non-taxable rollover? Option A, send the money back and assume the custodian will code it correctly. Option B, deposit the funds as a regular contribution to any IRA. Option C, contact the custodian, complete the 60-day rollover paperwork, and confirm coding as a rollover contribution. Option D, wait for tax season and fix it on your tax return only. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. You must contact the custodian, complete the 60-day rollover paperwork, and verify that the deposit is coded as a rollover contribution. This classification is essential to prevent the IRS from treating the movement as a taxable distribution. Now let's do one more quick question about timing. Next quiz. When does the 60-day rollover clock start? Option A, on the day you request the withdrawal. Option B, on the day after you receive the funds. Option C, on the day the custodian mails the check. Option D, on the last business day of the month. You may pause the video now to consider your answer. We will cover the correct answer in the next section. The correct answer is B. The 60-day window starts on the day after you receive the funds in your possession. Weekends and holidays count. Now let's reinforce your mental timeline with a dedicated diagram. This timeline shows the critical dates. Day 0 is when you receive the funds. Day 1 is when the clock begins. The target action window is days 1 through 45, allowing buffer time for paperwork and posting. Days 46 through 59 represent the caution zone when delays can be risky. Day 60 is the final day to get the deposit and paperwork completed. After day 61, you may explore self-certification relief under Revenue Procedure 2016-47 or consult a tax professional for options. Next, we will summarize the most important takeaways. The key takeaways are to act quickly within 60 days from the day after you receive funds, use the receiving custodian's rollover process with the correct forms, confirm that the coding is rollover contribution, replace any withheld taxes to make the full gross redeposit, respect the 1 per 12-month rule for indirect IRA rollovers, use direct transfers when possible to reduce mistakes, and document everything, including statements and Form 5498. Now let's wrap up with a brief summary and a call to action. In summary, an accidental IRA withdrawal can lead to income taxes and a 10% penalty. The 60-day indirect rollover provision can reverse the distribution when executed correctly. Proper paperwork and coding with your custodian are essential. Replace any withheld taxes and aim to complete the process well before day 60. If you miss the deadline, explore self-certification relief or consult a professional. Finally, we appreciate your time and have one last request. Thank you for watching. If this video helped you, please like, share, and subscribe. Share your questions and experiences in the comments. We read every comment and look forward to helping you make smarter money decisions.